What's up guys, this is Bobby, and today I wanted to talk to you about Bitcoin trading, why people get wrecked. So I want to give you guys a quick explanation. You may have heard of the term HODL when it comes to Bitcoin, and it's a term that was coined back in 2013 on the Bitcoin Talk forum. And HODL came about because someone misspelled hold, and HODL now stands for hold on for dear life. And why this is important is because, there's people who before you and I have ever even stepped on the face of this earth who were just trading in and out of assets. There have been people in the last 10 years and people in Bitcoin who've done this. So when it comes to trading and trying to time the market, it is near impossible. If you look at the data and go research trading, how challenging it is, it's near impossible. There was actually a bet by Warren Buffett and some other folks saying, who is gonna win, passive investing or active investing? And passive investing, by just buying and holding and just investing in ETFs and these other assets, not trying to play the market, passive wins. And when it comes to Bitcoin, the way we approach it is hodling. And this has to do with just holding on and not trying to trade. Why this is risky is for a couple of reasons. When you're trading, you're leaving your Bitcoin on exchanges. You are now trying to time the market, selling at the top, buying at the bottom. And whenever you leave your Bitcoin on exchanges, you are actually leaving yourself subject to what is called counterparty risk. And what counterparty risk means is now your coins are in the hands and in possession of someone else other than yourself. So when you're trading, you're giving your coins to someone else where they manage it. That's the risky part. The other part is trying to time the market. When you're trading, you're missing out on opportunities to be holding onto your Bitcoin and experiencing that upside gain that we have seen historically happen. Now, when it comes to trading, you also have to deal with taxes. And taxes suck. You need to talk to your own tax provider and tax person to really get the rundown on this, but there's short-term capital gains, which is a much higher percentage than the long-term capital gains rate. So talk to your tax advisor and learn about that and how it relates to you and your income and what bracket you're in. Also, when it comes to taxes, some important stuff is being able to accurately report it. This is where it gets kind of complicated for people. Personally, whenever I first started in 2017, I was trading a bunch, doing all this silly crap, and I've learned my lesson since then. But if you are going to do that at all, whether it be just buying and selling at a certain point, you need to have quality tax software to help you do this. There's a lot of providers out there. You should do your own due diligence and look into which ones are best for you and do your own research. The one I have used the last 3 years is cryptotrader.tax. They've done a great job for me making my reports easy for my tax advisor. I put in all of my information. What happens is it spits out these reports and you can just give it to your tax advisor. This kind of goes against the idea of the video I've been putting together here for you guys about not trading, but if you do, you need to make sure that you have a tool that makes taxes easy, because you're just opening yourself to a world of hurt if you do not report your taxes accurately. So we've covered the counterparty risk of exchanges. We've covered a little bit about taxes that you have to pay and timing the market, how hard it is. Me personally, I have a strategy of just buying and holding. Over time, I think it's smart, and what a lot of investors do, dollar cost averaging. Whenever it comes to dollar cost averaging, what you're doing is you're just simply buying an asset, holding it, and doing that consistently. With Bitcoin, I set up purchases weekly or with every paycheck. This is a smart way to approach it because you're not trying to time the market and buy all these random times. So you should look into that and consider it and do your own research and learn what that means and how that impacts your portfolio. The good thing about dollar cost averaging and not trading in and out is you're making consistent purchases and you're consistently getting exposure. Why this is important versus trading is, versus timing the market and moving in and out and giving yourself just availability to that counterparty risk is with dollar cost averaging, you are just buying it and holding it. And what it gives you the opportunity to do, hodling like we talked about, is saving your Bitcoin, taking it from an exchange and putting it on your own private key. What's a private key? Well, this is where you take custody of your assets, you take it off an exchange, and you put it on your own keys. What this means is you're gonna be generating a phrase that is 12 to 24 words, and you are now securing your Bitcoin on the blockchain, and that key is your access to it. So this is something you do not want to lose. So you should look into that and be very serious about protecting yourself and learning that component. I hope this video was helpful. We broke down a few different things: hodling, not trading. We broke down some of the counterparty risk you put yourself subject to when trading. Also the headache of taxes. And then there's a couple of tools you can use like cryptotrader.tax. I put it down below so you can take a look at it and consider that. I hope this was helpful. Like, subscribe, share some comments below, and I appreciate you guys. I will be making more videos like this in the future, hoping to add some value and answer some common questions. Talk soon.